Good afternoon and welcome to our webinar, Ways to Boost Your Super Before Retiring. This afternoon's webinar will run for about an hour. It's being recorded and will be available on our website shortly. My name is Zoe Nikakis and I'm a part of First Super's marketing team. Let's begin with the acknowledgement of country. Let me begin by acknowledging the traditional owners of the land on which we meet and by paying my respects to their elders, past, present and emerging. I also extend that respect to Aboriginal and Torres Strait Islander peoples attending this event. Firstly, thank you for joining us this afternoon. We're excited to be here. We encourage you to ask questions using the Q&A button at the bottom of your Zoom screen. Questions are anonymous and we will do our very best to answer them all. Before handing over to our financial advice team, there are a couple of important housekeeping items I need to cover. First, a bit about us at First Super. We're an industry super fund with more than 70,000 members and $5 billion in funds under management. We have strong industry links, as you can imagine. We have a dedicated member services team and provide local, personalised service. You can take us with you for life, from accumulation to your transition to retirement, and finally onto a retirement income account. Onto the disclaimers. It wouldn't be superannuation without disclaimers. The content in this presentation has been prepared by First Super and may not be used or reproduced without prior written consent. The information in this presentation is accurate as of today's date, Tuesday, 22 July 2025. First Super has engaged Industry Fund Services to provide financial advice to our members. All our financial advisors are authorised representatives of IFS. Further information regarding the cost of advice is set out in our financial services guide. The information in this presentation this afternoon explains concepts, strategies, and ideas in a general way. If you feel it could be applicable to your personal situation, we recommend you obtain financial advice before taking any action. Now let's meet the team. Joining us today is Andrew Jewell, our Executive Manager, Financial Advice and Education, and financial advisors Jason Bruce and Richard Gosling. Let's welcome Andrew.
Thank you very much, Zoe, and welcome everybody, and thank you very much for joining us. So as Zoe mentioned, today's presentation is aimed at members that are wanting to boost their super before they do retire. So it suits those members that are thinking about retiring about 12 to 5 years out, and what is it that they can do to accumulate some more super before they do retire. If there's anyone that's watching this video or have joined us today and is actually thinking about retiring in 12 months or less, there is another webinar called Retiring in 12 Months that may be more appropriate for you about how to manage your super. But like I say, today is very much about those members that are planning retirement and looking at retiring in the next 12 months to 5 years. So let's start off with retirement. And that's kind of like the real key to boosting your super. And do you, or are you on track? Well, one of the things that we do here at First Super when we're talking to our members about, and as they're planning for retirement, is talk to them about the ASFA retirement standards. And what I'm going to do is hand over to Jason and ask him to explain. Jason, what is ASFA retirement standard?
Thanks, Andy. Yeah, so ASFA stands for the Association of Super Funds of Australia. They're a government body, and what they look to do is provide a little bit of an outline for retirees or pre-retirees around how much money they might need in retirement and what sort of lifestyle they can expect. For a lot of our members, you might have been working for 30, 40, 50 years, paying off debt, raising kids, or doing, a range of different things, and now you're going into retirement. So it's a completely different phase of life. And so ASFA provides these two sort of pillars for us to have a bit of a guide in terms of what we can expect in retirement. So you can see here we've got two lifestyles that are underpinned by ASFA. It's the modest lifestyle and the comfortable lifestyle. They're just sort of descriptive terms. We normally sort of say it's more of an active lifestyle on the comfortable side of things. So it's not saying that if you want a modest lifestyle, you're not necessarily comfortable. But what the modest lifestyle is, it is a little bit more of a basic level of living for our members. So there's sort of limited discretionary expending. The age pension is going to cover a majority of your expenses in this case. You're not going to be doing a lot of sort of traveling, certainly not overseas. It might be some short trips, not going out for dinner too often. So the home and family is often a very big component of this modest lifestyle. As opposed to your comfortable lifestyle where you're most certainly very, very active. So it's a very social sort of lifestyle with regular travel, leisurely activities, some additional expenses, even coming down to things like going out for dinner, having, multiple subscriptions of Netflix and KO and whatever else we've got these days. In order to get that comfortable lifestyle, one of the main things that we have to do is build up your assets and build up your superannuation to be able to afford it, because it's much more than what the age pension is going to provide.
And I guess on that point, I mean, if I was a member and I was watching this video or as I'm attending today, I'm going, okay, yep. Yeah, that's the kind of lifestyle I'm thinking about. And, to what your point before, no one fits into these buckets perfectly, but the general description is, yes, that's what I'm looking at doing. How much income do I need, and how much in superannuation or financial assets do I need to have that type of lifestyle?
Yeah, sure. So I guess starting off with the modest lifestyle, for a single or a couple, we say that the funds or the super that we need to build up is 100,000. The reason why is because your income is very close to what the age pension is. So if you're primarily getting, the full age pension at that point, your super is just topping you off a little bit. Your age pension's covering most of your needs, and then your super is just giving you a little bit more to do those couple of little things that you want to do to make life a little bit more comfortable for you. On the comfortable side of things, we can see the income there for a single and a couple. It's almost double what we would need for the modest lifestyle. So we need to generate, a lot more income, and therefore our assets need to be significantly higher for really two reasons. So the first reason is if we're going to be self-funded and need that extra amount, that's got to come from somewhere. But also, in addition to that, you might not be getting the full age pension. So we don't touch on that too much, but the more assets you've got, the more super you've got, the government might say you're entitled to a little bit less of an age pension. So it puts a little bit more stress on your superannuation to be able to meet that comfortable lifestyle.
That's the another thing, the big key one here is that modest lifestyle, and that potentially you just need $100,000 in which to enjoy that. And that has surprised a number of our members. There are members with around about that 100,000 or just a little bit more, and they do feel like they just haven't got enough in which to retire. But when we sit down with them and we explore what is it they want to do in their retirement years, it very much fits into this modest bucket, and consequently they're quite surprised that they're in a better position. But let's delve down a little bit deeper. Why? You touched on it before, that for this modest lifestyle, for a single or a couple, you potentially only need about $100,000 in super. So let's go down and see what the age pension is actually playing in this role, and I'll get you to talk through this slide here.
Yeah, sure. So age pension differs for a single and a couple. So it's at a full rate of payment. So if you're entitled to the full age pension, so there's also an assets and income test that you do have to go through. But if you do pass them and you get the full age pension, for a single person, it's around $11.50 per fortnight. Okay, and a couple, you're looking at 1,732. So it's not quite double. Some people question that. It's because as a couple, you share a lot of expenses, your electricity, your rates and all that sort of thing are shared, really. Okay, so that's why it's not quite double. If you then look at the next column out to the modest lifestyle, it's around about an extra $150 a fortnight. So that gap that you're bridging is very small. It's only a few $1,000s a year. So if you've got a little bit of a nest egg, that is what is needed to bridge that gap. And it gives you a little bit more flexibility if an opportunity comes up to do a little bit of travel or do something. That's where you can meet that modest lifestyle and do a little bit extra. If you're looking, however, at that far side on the right, that comfortable lifestyle, as you can see, that income requirement is around about double what the age pension is. So it's quite a significant gap if you don't have the superannuation or the retirement savings to meet that on a consistent basis. And we're looking for a long funding period over the course of retirement. That's why we need to build up that 600 odd thousand in superannuation.
All right, excellent. I mean, and very much on that point, you're saying, for that modest lifestyle, you just really need to top up the age pension. Again, we talked to a number of members and they feel like they could just live on the age pension and they potentially may be able to in that regards. But I know from my own personal perspective, my mum in particular, I mean, she was a renter. She didn't have much financial assets behind her. She was getting the full age pension, but my brothers and I were having to substitute or supplement her income needs. So we were kicking in an extra couple of $1,000s each every year. And it's very much to your point. It was just giving her that extra $3,000, $4,000, $5,000 per annum, but that enabled her to enjoy life a lot more than just relying on the age pension, because it's the same old story. And members may hear from relatives and friends and colleagues how, if they are relying on the age pension, they just don't feel like it's actually giving them the lifestyle that they're wanting to enjoy. And they're having to be very conscious and they're struggling to a degree. So that's a great explanation. So, okay. What we started off with is, thinking about the retirement lifestyle that I want, and we've given an indication potentially how much funds you may need in that respect, and then, consequently, what type of income am I looking in? And the assumptions around the ASPER retirement standard is that the age pension is playing a role in all this, and consequently, you've reached the age pension age of 67. But what if I want to retire a little bit earlier? What if I got a little bit more? What type of income could I actually look at deriving? And what if I want to spend more than what that comfortable lifestyle is recommending? And that's consequently where we're moving into the retirement health check. So, Richard, if I can just get you to explain what is a retirement health check, and we go into a bit of a case study.
Yep. So basically, the best way to describe it, it's what we would classify as a capital adequacy projection. So in simple terms, do I have enough money in my super to last through my retirement years? So we basically have a process we go through that allows us to put in your assets, your expected retirement income, so we can use the modest or the comfortable lifestyles, or you may have actually gone through and done an analysis yourself to determine how much income you actually need for your particular retirement. We will flow in things like living expenses. Outside of that, we might look at updating the car. Could be things where we might want to put a caravan or something like that into the discussion. And then what we can do is just basically run that through and give a projection, which actually tells us whether you're going to have enough money to be able to retire at the time with those parameters in place, or whether your situation is going to show that, yeah, you may get through, but there will be a point there where you do run out of money. And from the perspective of talking to so many members over the years, I think the biggest thing we find is the fear that we may run out of income and capital in retirement. So this is basically, it's not overlaid with any advice. It's just purely put the numbers in. When we start to provide advice moving forward, we may need to look at a little bit beyond just the retirement health check. And that's where the guys will come in and start to look at some strategy, etc., to try and build on that assets in your superannuation from there.
Excellent. So, just to recap, the ASPER retirement standards is kind of like guidelines. They're giving the bookends around it all, but the retirement health checks actually brings it back down to the individual and their personal circumstances. So, if I can I get you to talk us through a case study and showing us how this all works?
Yep. So this particular case study, we've got a couple, both age 59, so under 60 years of age, which is important, as we'll go through in a few slides coming through. But basically, Barry's working full-time, has been for a number of years. Debbie's part-time. They have some children and they've all grown up and left home. They've paid off their debt. They may at some point move in, downsize their house and into a smaller, which will free up potentially some capital. They have some superannuation, Barry with 250,000 and Debbie with a modest amount of 25. Income levels are stated, and we haven't seen Barry doing any salary sacrifice strategies, etc. Now, they both want to retire within the next 5 years. So we've put all this information in, collated that, and then we will come out from there to determine, which the next slide will show exactly where they're positioned from the projection. And this is the projection I find with my discussions with members is we can put all the words and things around it, but the projection is actually a pretty clear way of demonstrating what your capital looks like. So key thing there, if we look at 59 years of age and we've got the first 5 years, you can see the dark blue bars heading upwards. That is the income that's being generated from their employment. And you can see there's an orange line tracking through, which is the expenditure, and that's showing you in that instance there, their expenditure is being met from their income. That's 5 years down the track, you can see that expenditure figure drops off. So what that's basically saying is with their current income needs while they're working are a bit higher, when they get to their position with retirement, we can see there they need somewhere in the vicinity of just probably around 50 grand a year to live on during their retirement years. So if we look at the bars, the green bars coming back up, basically they are what we call income streams. So we have started to use some of our superannuation to bridge that gap from the retirement age of 65 through to actually being eligible for age pension. So they've started to draw on their super at that time. And the main thing we want to look at there is the blue shaded area at the back, which is actually demonstrating what is happening with their capital. So if we track that right through to life expectancy plus 5 years, so we say they're at 92, you can see there that they haven't still got capital left over. There is another bar that jumps in there with the expenditure, and that kicks in at 67, and that is the age pension coming in. And you can see there the light green bar has backed off, which means that they don't need as much income from their account-based pension, and therefore we don't need to draw as much, which means that they're actually not utilising as much capital in their retirement from there. So the key thing with this is if that grey shaded area or the blue shaded area at the back starts to drop away and we cannot get the income to meet to that expenditure bar, then we know they've run out of money. So in this scenario, it clearly shows to us graphically that they are able to meet their objectives as per stated on the retirement. That's pretty much what the retirement health check does. It just gives a visual representation of what retirement looks like, and am I going to be in a position where I can retire earlier than initially first thought. So it's really just a test to see where we sit.
All right, excellent. Thank you very much. Great explanation. So what we've done so far is talked about retirement and what is it that you need to think about, the lifestyle that you're wanting to enjoy, and consequently, what type of income is it that you're going to need, and subsequently, how much is it that I need to have accumulated in superannuation and other financial assets. And if I'm wanting to retire before the age pension age, then there's a retirement health check that can give you an indication whether you're on track or not around it all. And consequently, that ties into very much the next section and the essence of this seminar, and that is, what if I'm not on track? What if I'm not going to have enough super or accumulated enough super that's going to last all throughout my retirement years? Or what if I just want to build up a stronger balance so I can really enjoy my retirement years, and there's a few more things I would like to do? Maybe I would just want to travel overseas a little bit more frequently. Or maybe I just want to make sure I've got some provisions there for, somewhere down the track, I'm going to have to think about aged care services around that for myself. So again, what we're really coming back to then is, what are some of the ways that I can build up my superannuation effectively before I do retire? So we're going to move into the contributions. And Jason, if I can just get you to explain what options are available to members if they want to make some additional contributions into their super.
Yeah, so the most controllable way to build our super is by putting more money into it, and there's effectively two ways that you can do it. So the first one on the left-hand side there is your before tax contributions, which are your most common ones. They're what we call concessional contributions as a technical term. Why they're called that is because they are concessionally taxed. So any money that goes into your super as a before tax contribution goes in there at a rate of tax of 15%. For most Australians that are working full time on a little bit of a higher income, a lot of your wages are taxed at up to 30% generally for a lot of Australians working full time. So by putting some additional money in as a before tax contribution, we're reducing the tax that we pay on that wage. Okay. And the most common one that most people will have heard about these days is your salary sacrifice. So I'm sacrificing a little bit of my wage, so my take home pay does drop a little bit, but I'm directing that into my super account. It's getting taxed a little bit less, so I can put in a little bit more. I'm saving a little bit more, less money goes to the tax man, and we start to build up our super account. In addition to that, your employer contributions, so whatever your employer is putting in as a superannuation guarantee payment is also before tax, and that's been rising up to 12% now. And any what we call additional deductible contributions as well. So what that is throughout the course of the year, if you've saved up a little bit of money and you whack it into your super as a lump sum, you can claim it as a salary sacrifice type of contribution. It'll get taxed at 15% and reduce your income tax and get you a little bit of a tax refund as well. The thing to be mindful with the before tax contributions is that we are limited or capped to $30,000 per financial year. And that's obviously including what your employer puts in. So we can get up to that limit fairly quickly. The last dot point there refers to the carry forward rule. It's a reasonably recent introduction that we'll talk about on the next slide, but it gives us a little bit of flexibility to go over that $30,000 cap. So that's the before tax. That's how we can build it up and save ourselves a little bit of tax. Our after-tax contributions, do we have a little bit more money to put in? And potentially that's where we're starting to look at your after-tax or your non-concessional contributions. Now, those contributions do not attract any tax on the way into the super fund. So there's no additional tax. Whatever you put in goes in there as an investment, but you don't get those little tax breaks that you would get from your salary sacrifice or your additional deductible contributions. The cap is 120,000 per financial year. So it's 4 times your before tax cap. And you can also bring forward 3 years of future contributions to do up to 360,000 as a one-off shot if you're under the age of 75. So this could be really suitable for a lot of people. We've had a lot of members that might have sold a property, sold some investments, or maybe even just during their working life saved a bit of money and they're thinking, well, maybe I've got a better option than having it sit in the bank. Can I put it into super? I've already paid tax on it. I don't want to pay tax again. I can put it into super as an after-tax contribution as well. The last point there is the government co-contribution. So if you're earning a little bit less money, the government does match your after-tax contributions up to 50 cents in a dollar. They do cap it at $500 though, unfortunately. So it's not an unlimited way to create some wealth. But if you're on a lower income, certainly your after-tax contributions can be quite favorable. Your before-tax contributions, certainly as your income goes up, and if you're on a higher income bracket, that's where they can really be beneficial to save you a fair bit of tax.
All right, excellent. And you've made reference before to the carry forward rule. So maybe we just have a look at a bit of a case study and we get you to explain what is this carry forward rule and how is it, if a member wants to look into this further, where can they get the information from?
Sure. So the carry forward rule started in 2018-19, so it's reasonably new. It works on a rolling 5-year basis and your super balance must be below 500,000 at the start of the financial year. So if you do, for argument's sake, in December, tip over 500,000, well, as long as it was under 500,000 at the start of the financial year, you'll still be eligible. To find out what your carry forward available cap is, you go into your MyGov, and that's the source of truth in terms of where we can find it. The ATO knows everything and they can provide you with what your carry forward is. But working through this worked example, we've got Sylvia here, whose total super balance at the start of the financial year or end of the past one was 350,000. So we know because she had less than 500,000, she's eligible to use this rule. She has recently started to do some salary sacrifice. So in the middle there, additional concessional contributions. She's done 5,000 over the past few years, and her employer contributions have been reasonably consistent, with potentially a couple of pay rises and the super guarantee going up. So every year over the last 5 years, Sylvia hasn't gone up to the cap. Okay, so again, it's 30,000 this year, but previously it was a little bit less. But in any case, she hasn't used or utilized her cap over the last 5 years. So you can see that it's quite a staggering amount actually in this last year of $93,000 of carry forward contributions that she has left over. So that gets added to this current financial year, and Sylvia can add that to her normal $30,000 cap and put in a heap of money before tax. So it's a really powerful tool to really save us tax and to really start to accelerate our retirement savings. If we're starting to think about, I want to retire in 2 or 3 years, I've got a little bit of surplus income, maybe I've got some money in the bank, maybe I've just paid off my mortgage, and I really want to ramp up the super, your carry forward rule can be a really powerful tool to allow you to do that.
All right, excellent. So, I mean, from speaking with members around this carry forward rule and making these additional contributions, can you give me an example of what kind of advice, discussions you had with our members on these matters?
Yeah, so I did have a member who he just actually retired only a few weeks ago, actually, but he came to see me a couple of years ago. Again, his first sort of entrance into financial advice. He'd had a reasonable super balance and he was contributing a little bit more, but he had a fair bit of money in the bank. So they'd paid off their mortgage. They were saving a bit. Both he and his wife were working full time, empty nesters. So they had quite a bit of surplus income. So what we were looking at with him, he had around about 20 to 30,000 of carry forward amount. So we were able to really accelerate his salary sacrifice, go over that $30,000 cap, and start to reduce his tax while building up his super. So we're able to put in around about 40,000 a year over the last 2 financial years, which means there's about another $80,000 into his super account, and saved him a heap of tax in the interim. And now he's very happily entering into retirement and drawing an income stream.
All right, excellent. Thank you very much. And Richard, you were talking to a member where it was a different approach, but it was using still the carry forward rule. Can you just share what happened in that instance?
Yeah, so we had a couple, both under the 500,000, and they had an investment property that was jointly owned, and as a result, they had decided to sell the property. Once they sold the property, so I can give you some numbers around what that was like, but they sold the property, which triggered a capital gain in the financial year. When we started to look at what their options were, they had obviously had some discussions with their accountant and were a bit concerned about the amount of tax that they were going to have to pay. So in this particular scenario, they'd only been making their employer contribution, so they had a fair bit of cap space left over that they hadn't used under this carry forward rule. So the capital gain, as it turned out, for this particular property was a realised gain of 240,000. And when they applied the 50% discount, which is had the property more than 12 months, they were both in a situation where they had assessable income of an additional 60,000 for that financial year. Obviously, there with a normal cap of 30,000, a small amount of SGC being paid in, they had a reasonable amount of the carry forward space left. So we actually put, from the proceeds of the property sale, some more money into their superannuation, and we were able to eliminate the tax on the capital gain by putting 60,000 each in. So what that effectively meant is, by making that personal contribution, they were, when we looked at the tax and their marginal tax rates and the Medicare levy, they were effectively both saving themselves having to pay out $10,200 in additional tax. They did albeit had to pay some tax when they went into the super fund as a contribution. But when we look at their marginal tax rate, Medicare levy was at 32%, 15% versus 32 was a pretty good outcome for them. So that meant that there was effectively, between the pair of them, an additional $20,000 odd that they didn't pay in tax that particular year.
Very good, very good. So two great examples of how people can use the carry forward rule to their advantage and minimise their income tax. We've actually received a question on this topic, but before we answer that, Jason, I will throw you the question. We've got another question that came in earlier around the UK pension. We will answer that in the Q&A. And also a number of our members have submitted questions prior to the webinar today. A number of them actually to do with the next subject. So we will answer those during that next part of the presentation. And there's a couple of others that we will answer in the Q&A session as well. But coming back to this carry forward rule, the question that's been raised is, do you need to apply for the carry forward rule, or will the ATO apply automatically? So maybe, Jason, if you just can clarify about, where is it that the member finds this information and how frequently is it updated?
Yeah, so again, through your MyGov, it'll show you your carry forward amount. You don't have to apply it. The ATO knows what you're contributing every year, and they know what your carry forward amount is. So if you do go over it, the ATO will automatically apply it. Just, I guess, working through how it works in this example with Sylvia. So if this financial year, for argument's sake, she put in 40,000 worth of concessional contributions. So she's gone over her limit by 10,000. The way it works in practice is that extra 10,000 will go against the furthest year back. Okay, so that would be pushed up against the 2020 to 2021 financial year. And allocated effectively to that year. Okay, so it just automatically goes from the furthest year back until you hopefully you're able to exhaust all of it.
All right. So, I mean, again, to your point, ATO holds the record on the carry forward amount. So if you go to MyGov, ATO Super, and then go to the drop-down menu, carry forward rule, it'll show you how much is available there. The thing to be wary of is that the ATO doesn't update it regularly. They basically approach all the super funds and ask for the relative information from those super funds and then collate it. So it gets updated around about October. So if you went in there today, it's not the figure that's available to you at this moment in time. It's probably last year's. So it gets updated around October, and I think it gets updated again around about March. So again, just be wary if you're trying to use all of it. And be conscious about what you have contributed during this financial year, and not pushing the point, but raising the value of it. This is where financial advice comes into play to make sure you don't exceed that cap, because the last thing you want to do is exceed it, because there's a few penalties that are applied in that regards. But hopefully you answered the question for the member, and we've clarified about where you get the information from and how you can use it. So with all this in mind, then, I mean, making these additional contributions really comes down to is, as in, yes, where I am in my life and my finances, we're doing quite well, and we've got this surplus cash flow. Is probably a nice way to describe it. Or we've come into some money. Going back to your earlier points, maybe it's even an inheritance that you come into, or something like that, of that regards. But for a number of our members going, well, I'm not in that situation. With the cost of living nowadays, we're just managing. I don't have surplus cash flow, and my parents are in very good health, so there's no inheritance I'm expecting in the near future. But how is it that I can try and boost my superannuation before I do retire? And that's what we refer to transition to retirement. So, Richard, can I get you to explain what is commonly known as TTR?
Yeah, so TTR, an acronym that we use, but obviously it just means transitioning to retirement. So to give some background on it, it was initially some legislation that was passed in July in 2005. So we're going back 20 years. I do remember this coming through. I was advising, have been prior to that time. But basically the government was trying to encourage people, effectively trying to free up some people in the workforce, try and bring the next generation through. So one of the methods they looked at that was those that potentially wanted to work less, not continue to work at the level of hours. So instead of working a 5-day week, they might want to come back to a 3-day week. So they recognised that was going to be beneficial to the next generation coming through. But it did present some challenges. So they put some encouraging legislation in place because most people had this large pool of superannuation or a pool of funds sitting there, but they weren't able to access it to enable them to retire a little bit earlier or reduce their working hours. So what they did is they allowed you to roll some of your money out of your superannuation accumulation phase into this transition to retirement. in order to provide some additional income into the household whilst you had just taken a pay cut because you'd cut your hours back. So in a situation where this is what it was designed for, you could effectively have the same income that you were when you're working full-time, but in a part-time capacity by drawing down on your superannuation. There were some other changes that have applied to it, but there is some restrictions. So basically you need to be 60 years of age, and there are some limitations in how much you can actually draw from the pension fund once it is set up. Just as a further note, there was some tweaks to the legislation in 2017. So they ran it for 12 years on that basis, and that was more around the taxation of the actual fund, the investment earnings inside the transition retirement. It used to be fully exempt from tax on the earnings. So I'm talking about the investment income. That is now taxed the same as what your accumulation account would be, but the income that is provided from that transition retirement pension that you pay in your bank account is fully exempted from tax. So there's a tax-free investment income from there. So that's pretty much how we use it. So basically it's someone that wants to cut back their hours, obviously take a cut in their pay levels, and then utilize their superannuation to bridge that gap in the foregone income through that lower income position from the cutting your hours back.
All right. So maybe it would be good if we just gave some examples again, how we've been speaking with our members and guiding them and providing them advice, utilizing this strategy. So Richard, if I can just go back to you, there was a member that you were assisting and you were showing them how they could actually save more or build up their superannuation before retirement.
Yeah. So there is, so when we looked at all this, the strategy was designed around the work less. As a result of planners getting involved and looking at strategic advice, etc., there was a loophole, well, not so much a loophole, but an opportunity to accelerate your superannuation. So instead of someone working less, we can actually use it to accelerate your salary sacrifice, and therefore also effectively you are reducing your take-home pay, but we can then supplement that income with a transition or retirement pension by building the additional income coming into your bank account so that you can match up with your take-home payment that you have. That's important that we obviously know what that figure is, because if we don't know what that figure is, we don't know how much we can vary the adjustments for the income that you need to generate from your transition or retirement, or also look at what that salary sacrifice level. So that can bring things like that carry forward rule back into play from there. So one of the members I did was more around the work less strategy, where they wanted to cut their hours back. We worked out what the income they needed, and then we basically set up a transition or retirement to cover that income gap from their less hours that they were working from there.
All right, excellent. And I think that kind of answers one of the questions that was posted as well. And the question was, can I semi-retire a year or two earlier and cut the days that I work down by partially accessing my super? So what you described just then is exactly answering that question in that regards. And to your point before, the two key requirements is you've got to reach preservation age, which is currently age 60. And there's a maximum that you can draw down from your TTR account. So depending upon how much you initially put in, the maximum you can draw down is 10%. So it is kind of like balancing how much income do I need, and am I going to get enough from my super account if I'm cutting back on my work hours. And to your point before, it's very much coming back to that's where financial advice comes into play, giving you guidance on about how to best set up this TTR account to meet those income needs. Jason, if we go back before to the carry forward rule case study you were using, you used this TTR strategy in conjunction with that carry forward rule as well for a particular member. Can you just share a little bit more on that?
Yeah, sure. I suppose it brings it full circle a little bit. So the member that I saw just recently turned 60. She had about 100,000 in her super and still had a mortgage. So she was a little bit later to the workforce. She'd previously lived overseas and had come across. So she really wanted to build up that super. Now, what she could afford after sort of meeting her living expenses was that she was able to contribute via salary sacrifice up to around that $30,000 cap. And that was great. So that'll certainly build up her super. But then we sort of thought, well, can we go even more? Like you've got a lot of carry forward available as well. but she didn't have the cash flow. So what we did for this member is we used a transition to retirement. Again, it was around about 100,000. So we're able to take that maximum 10% and contribute that in basically each financial year to utilize her carry forward and go above that $30,000 cap. So that was reducing her tax. It was building her super through her regular contributions, but also through this transition to retirement that was saving her a little bit extra, getting her a little bit of a tax refund, which she could then use towards, putting against her debt and those sorts of things as well. So yeah, she was really looking to build her super, and we're able to do it both ways. So it's not just sort of one or the other that we can do. We can look at the whole situation, everything that's available to that member, and what gets her, in this case, the best financial outcome, which was doing a little bit of both.
A little bit of both. All right, and then you touched on it kind of like a key consideration, and then I've been speaking with a number of members, and the reality is that there's a growing proportion of the population that are now retiring, and they've still got home loan debt around it. And going back to Richard's point before, I mean, it's, traditionally, if you want to call it, the TTR strategy was set up for people reducing their working hours but needed to supplement their income. But because of the rules around the TTR, it allowed people to boost it, like you just described, Jason. And consequently, this is where, again, they're able to leverage off these rules, and they can use the TTR strategy to actually accelerate the repayment of their home loan. So they can draw down the additional income. It's non-assessable tax-free income, and they can put that towards their home loan and make sure that that home loan is either paid off or considerably reduced before they do retire. Again, it's going to have an impact on their potential funds available during their retirement years, but it may be in their best financial interest to take that approach. And again, without trying to push it too far, this is where financial advice comes into play. What's the best way for me to manage my home loan and make sure that it's reduced or paid off by the time I do retire? Is a TTR strategy something I should be thinking about in that regards? All right, so we've talked so far around about retirement. What do I need to have a look at? How much income am I needing if I want this particular lifestyle? And how much superannuation, other capital do I need behind me to support me? It's all fine if I'm using the ASFA retirement standards, but if I'm not retiring at age 67 and I want to do it earlier, then the retirement health check comes into play, and it gives we can build upon other factors, upgrading, the car, purchasing the caravan, as Richard described before. And if I'm not in the situation where I've got enough superannuation, or I just want a larger amount when I do retire, just to keep my peace of mind, then how do I boost my superannuation through these contribution options? And if I don't have the cash flow or the funds behind me to make these additional contributions, how is it that I can use the TTR around it? So these are kind of like the key principles, the key strategies that assist people in boosting their super before they do retire. And like everything within superannuation, there's always an exemption. There's always one more rule, and it's something called the downsizer contribution. And Jason, if I can just get you to quickly explain, what is the downsizer contribution?
Sure. The downsizing contribution, again, is reasonably recent. I guess it's been put forth by the government to address a bit of a housing crisis and, encourage older Australians to free up their large family homes and open up those homes for younger families. So with the downsizing contribution, you have to be at least 55 to be eligible for this, and you have to have owned your home for more than 10 years before the sale. And you also have to be pretty quick with it as well. So it's not on this slide, but you have to get the money into the super fund within 90 days of settlement. What you can do with the sale proceeds is contribute basically up to $300,000 for each person. So if you're a couple, $600,000 combined. It goes in as an after-tax contribution, so there's no tax that you have to pay on the way into the super fund, and it can boost your super. So when we spoke about those after-tax contributions in the last slide, you had to be under 75. That doesn't apply. I've had some older members in their late 70s and early 80s who have downsized and were able to do this downsizer contribution, whereas they otherwise wouldn't have been able to put any money into super at all.
All right, fantastic, excellent. All right, so we're going to just wrap up the webinar here today, the presentation. We're just going to answer a few questions that have come in. And Richard, if I can just go back to you. The question to my mind relates to the TTR strategy. The members asked, I'm still working. How do I open a retirement account?
Yep. So basically, the TTR account is rolling over from your existing superannuation. A portion of that, depending on how much income you need to generate, we've got to work within the parameters of the 10%. But it's just simply completing an application form, which can be found on the website. But being a financial advisor, I would encourage that you get advice and get some assistance with that, just to ensure that you're not running afoul of any of the restrictions, etc. from there. But it is quite a simple process as far as establishing it, and working within those parameters. You can draw your income on a fortnightly basis, can be drawn on as an annual lump sum type payment. But one of the big things to remember is you do not have access to the capital, so you can't make a lump sum withdrawal out of the balance proceeds from there. But yeah, it's just completing an application form, and I would preface that with advice.
Yeah, thank you very much. Jason, this is kind of like a bit more of a wider open question. The members asked, how do I save tax on super?
Sure. So definitely, depending on your level of income is probably the main thing. So if you're not working, or if you're working a little bit, then perhaps your salary sacrifice and those before tax contributions aren't necessarily appropriate for you. If you're working and you're a bit of a higher income, that's where you can sort of look at those before tax contributions, putting that into your super to save you a little bit of tax. And you can also couple that with that transition to retirement if you don't have the sufficient income to enable you to make those contributions.
All right, thank you very much. We've got 2 more additional questions live today, but before we go to those, I just want to answer one other question. Again, it was posted before the webinar today. Is transitioning to retirement relying on your super in retirement affected in any way by receiving a UK pension? And I will answer that. The question is yes. If you have retired and you're using your super to derive an income, the UK pension does have no effect on that at all. That's not a consideration, because your Australian super is actually non-assessable, tax-free income. The UK pension that you're receiving from overseas is an assessable income, but it doesn't get double taxed because of the tax arrangement between Australia and the UK. So on tax advice, you really need to talk to a tax advisor in respect to that. When you get to pension age, Centrelink deems your UK pension to be another source of income. So it does fall underneath the income test, and consequently it can reduce your Australian age pension. So like my mum, she was born in the UK, she receives a UK pension, and consequently her Australian pension is reduced accordingly. And it's kind of like done every month. It's based on the exchange rate. It can get a little bit technical. But the other kind of like comments in regards to that, if you do have a UK pension, it's complex, the UK pension, in comparison to the Australian one. And there are considerations that you do need to be making. So if you're seeking some advice around how to best manage your UK pension, we do suggest that you actually speak to a financial advisor that specializes in that particular area, because like I say, it can become quite complex depending upon what type of UK pension you do have. Okay, it's actually 3 questions we've got now. Jason, I will go back to you. The question is, can you do a downsizing option if your current super is greater than $500,000?
Yeah, sure. So that $500,000 figure is just for the carry forward. So that's that one. If you want to do a downsizer, yeah, if your balance is above that, you can absolutely go for it.
Yeah. Richard, I'll throw this next question to you. If I want to add inherited funds to my super fund, are there any fees?
No fees to add to it. As we basically mentioned, there's 2 types of contributions you can make. It can be a concessional or a non-concessional. Obviously, if it's a concessional one, you're claiming a tax deduction for it. So you would want to ensure that you're not paying additional tax that you don't need to. And if you are in a process of saving tax, then yeah, you can add to your superannuation, but no fees are involved in the actual adding of that money to your fund.
All right, thank you very much. And the last question I've got here is, and I'll answer this. Just wanted to ask, the transferred KiwiSaver already taxed in New Zealand. How come if you transfer it to Australia, it's still being taxed? We will reach out to this particular member. We've got a specialist team down in our administration, and they're experts in the KiwiSaver. But if I've understood the question correctly, when you transfer the new KiwiSaver over from New Zealand into an Australian superannuation fund, and there's only a few that accept Kiwi transfers, such as First Super, it goes in as what Richard described before as a non-concessional contribution. So it doesn't get taxed again. Yes, it gets taxed in New Zealand, but it does not get taxed again here in Australia. The earnings on your Australian superannuation account do get taxed up to 15%, but it's the earnings. It's not the money that's come over from New Zealand. It certainly adds to the earnings. I'll acknowledge that, but literally the funds that you're bringing over from KiwiSaver are not taxed again because it's treated as a non-concessional contribution. So consequently, it goes into your super account tax-free in that regards. But we will, as I said, get our administration team just to reach out to this particular member to make sure they've understood that. All right, so those are all the questions that we've received today. And hopefully what we've done is to clarify to our members that if you're thinking about retiring and you're wondering whether you need to boost your superannuation or not, the place to start is actually your retirement, thinking about what is it that you want to do, and consequently start to get an understanding about how much income is it that I'm going to need to enjoy that lifestyle, and do I have enough funds in which to support it? So there is the ASFA Retirement Standard, which is a guide, or if you wanted it kind of like more around your personal circumstances and how much you've got in super, we do offer that retirement health check service that's available to you. It's about a 30-minute type of consultation with someone from the financial advice team. And regardless, if you think you've got enough super or not, you may just want to build upon it over the number of years before you do retire. So there are a number of contribution options that are available to you, including the carry forward rule, the bring forward rule, and the TTR strategy. And it's working out which one is better for you and how do I utilize that. So that's in my best financial interest. And then if you do happen to decide to downsize your home, then there's an option of the downsizer contribution that you can contribute as well. So as I say, the financial advice team is available. So if you're wanting to just discuss through your circumstances a bit more, you can go onto our website and make a request for one of the financial advice team members to reach out to you. Just a heads up, there is a waiting time at this moment, but we will book in a meeting as soon as we can at a convenient time and day. We do it in person, we do it by video conference, we can do it by telephone as well. So there's plenty of options that are available to you. And if anyone's really interested in the age pension and the retirement, if they actually are thinking about retiring in the next 12 months, remember there's another webinar video that's available on our website, and it's retirement in 12 months, and it goes through all that information with yourself. So thank you very much for joining us today, and hopefully we've answered a number of questions for you. And there will be a survey that comes out following this webinar. We'd love to hear your feedback. And again, you've got the option to reach out to the financial advice team. So until next time, thank you very much, and good afternoon.